One of your goals in real estate might be growing your portfolio, whether that means adding more doors to your portfolio, improving on the asset value. But what you're always going to be thinking about when evaluating properties is there going to be a good return on this? So whether you're new to investing, whether you already manage rental properties, or maybe you're a property manager or a real estate agent and you're advising clients on whether or not a property is going to be a good deal, here are some things that I like to think about during that initial evaluation. So I've already talked about the 1% rule. The 1% rule is that initial glance at a property, the listed purchase price, and the potential rental income that property could generate. So with the 1% rule, if a property is listed at $200,000 for sale, will I be able to collect $2,000 in rent to cover that expense? And that's usually my base rule of thumb. If it's a property I'm super interested or could potentially have more return on the investment, I'll do a little bit digging and do a further analysis on that one. But what else are we looking for besides purchase price? In this video, I'm going to go over some other things I consider to determine whether or not a property is going to be a good investment and potentially generate a positive return and be a good addition to my real estate portfolio. So let's think about what it takes when I do initial evaluations of a real estate property to determine if I should move forward with investing. Here are some of the things I like to look at, and we'll go into each one. Age, maintenance, of course, cost, what the average rent for the neighborhood is going to be, what the neighborhood actually looks like, and then what the income potential is going to be for that property. So let's break those down a little bit more. Age of the property. So we kind of do a standard rule, like if the property is more than 50 years old, we usually don't even consider evaluating it. This has to do with some of the building materials that were used in older constructions. Think lead-based paint or other chemicals that were used in construction that would make any maintenance on the property a little more expensive. We once were renovating a home that was built in 1920, and there are some damages done to the walls by the previous tenant. And when we said, hey, can you just replace the sheetrock on this wall? They found that there's actually asbestos in some of the building materials. So instead of this project being a simple wall replacement, they had to tent the entire house, hire a team that would actually go in and remove the asbestos from the entire property in order to then redo that wall. So that's one of the things that can happen when you think of a property that could be older, might require more maintenance, or have materials that you just don't want to be dealing with. Another thing with age is what other kind of maintenance are you going to use? Not only the building materials, but are they going to be needing appliances sooner? Are the sewer systems ones that you want to provide maintenance on? Again, I think of one property that we have that the numbers were really, really attractive. Like it was going to be such a great deal, but it has caused us a lot of maintenance issues, from replacing floors and dealing with septic issues, plumbing, all sorts of stuff. And although the numbers still pencil out to be very positive income-wise, the amount of overhead it takes on our end, I would almost think of it as not my favorite investment that we've made. Some of the other things we think about is that cost. Of course, like it always is going to come down to how much is that purchase price, and that will determine a little bit more of the return on the investment. And then what is the average rent that you're going to be able to generate in that area? So some communities you can charge premium rents, and other communities really you can't charge more than that average market rent. And the higher priced properties or the properties that require more maintenance, you can't even think about using that average rent of the area that might cover the cost of your expenses. So consider really that average rent for your area and then how that factors into the purchase price and what the return is going to be for you. And thinking about that area, what is the neighborhood actually like? Is this a neighborhood where you'll be able to attract tenants that you feel like will maintain the property, pay their rent on time, be amicable to work with, report maintenance issues? Is it a property that is in a neighborhood with neighbors who want to also maintain their properties to help with attracting qualified tenants? Is there other areas in the neighborhood that make it attractive to rent? Is it near public transit? Is it walkable? Restaurants, other schools? So different areas that can make the property really attractive. Maybe there's a really good deal somewhere, but it's right next to a railroad. So is that good because it's quick access to transportation, or is it actually a negative because you're going to be dealing with railway noise and it might actually be harder to rent, or maybe you're going to have charge a lower rent amount? And then I also like to think about what is the income potential of that property. It's not just market rent, and then is it going to be set like that for the rest of the time that you own it? But are there other ways that you can generate rental income? Maybe it's by a dog park, so attracting renters that have pets. Then you can charge a pet fee on top of your standard monthly rent. Are there areas of improvement that might not cost very much, or you could do within the next 5 to 10 years that can increase your income potential? Maybe you can collaborate in the neighborhood to do some sort of parking discount or access to, I guess I'm thinking about if it's located in a downtown area, can you work with your city to get a discounted parking pass, and then you can provide that pass to your tenants and maybe charge an administration fee on top of that as a potential rental income generator for you. So there's are just some factors that are interesting to think about when it comes to evaluating a rental property. It's not always about that 1% rule or taking that 1% rental analysis to see, well, how much is this actually going to cost? Because those all play a factor. But I always like to think about opportunity cost. How much energy and time is it going to take for me to manage this property, or to even communicate with a property manager about potential maintenance that it could have? And then how much will this property generate over time? I'm talking about those income potential options that we discussed. So there's lots that can come into evaluating a rental property. Price is one factor, but I like to think about all the big picture when I'm getting closer and closer to thinking about a property and saying, like, yes, let's get further and see if this is something we want to add to our portfolio. I'd love to hear about what else you think about when it comes to evaluating a property. Make sure to leave us a note in the comments. As always, you can follow me on the Rentec Direct blog. I'm Casey Miller with Rentec Direct. Come and visit me there and check out more videos to come.